Raise your hand.
Okay. All right. Thanks, everyone, for coming. I'm Rick Brown, Evesham Mortgage. Wanted to bring specific investors in here for you. Paul and Angelo work for a company called First Guarantee Mortgage Corporation. So, when it comes to mortgages, we're all used to the normal conventional FHA, USDA, those kind of things, right? Those are what we call QM mortgages, qualified mortgages. Over the last year or so, a new world has popped up. It's called non-QM. We've been working with First Guarantee for many, many years, but in the non-QM sphere, about a year. And what the non-QM does is opens up a world to investors and home buyers that has been closed. For instance, I was just telling Val, I have a buyer who hasn't filed tax returns in 2 years, but he's making $100,000 a month. So he done multiple W-2s, employees. So he just takes his paycheck, puts it in his bank statements. So now we'll take 12 or 24 months bank statements, calculate the income, and that's what we use as income. So these are the type of products that Paul, who's the specialist, that's the reason I wanted to bring Paul in, was because these loans are a little complicated and he'll be able to answer all of your questions a little bit better than I could. So that's why I brought Paul in. So I'm going to Angela.
I'll be the one answering.
Yeah. So I'm going to turn it over to Paul, and I'm going to get out of the way because he's the specialist. And there's the camera. All right, so stay here.
Stay in this general vicinity. Well, thank you. I appreciate that introduction and appreciate your time today. As we mentioned, what's really interesting in the real estate market for all of you is, deals have to close faster. A lot more unique borrowers are coming, out into the marketplace looking to for assurances from you and from financiers that they can get the deal done, right? So when you start off, with a borrower and they're self-employed and they're used to just having a stack of tax returns they have to give to a lender, someone who's going to originate their loan, it becomes really challenging sometimes when there's not enough income there to qualify, right? They have the income, you want to help them shop around, and you want to put them in a position where there's certainty behind a way to qualify them. So we're going to talk about, with non-agency or non-QM products, really how do we help more buyers that are out there in this changing economy. Every single day it's changing in some way. People are a little bit more industrious, more entrepreneurial, and we have these products today with the help of Evesham Mortgage that really are going to serve those unique buyers you probably run into pretty often. So you can trust, with our partnership, as was mentioned, we have just that long-standing relationship to help with these kinds of deals. So I'm going to kind of just go like a little bit of an overview right now. What makes a loan non-QM or a special financing loan? These are loans that you'll see customers have down payment, customers have good credit. They're looking for a way to get more affordability in the market now with prices rising for homes and the values. So we allow in these programs the ability to expand your debt to income ratio, how much you can borrow over your monthly payment. We can get these products, which you won't find very often with the agency offerings or traditional lending. You're going to see 50–55% debt to income ratio under this product. So again, another way to maximize their financing when those values are increasing with those higher debt to income ratios. It may not matter as much to the audience here, but I think what's really important when you see these programs, you remember the subprime days, that bad word from back in the day. These loans are definitely not falling into that criteria. We're qualifying borrowers very closely. We even run special fraud detection when we're using bank statements to qualify. We're looking at people with money down. These customers need trade lines. So you're going to see trade lines. There's a lot more we're looking at, and we're looking at these, and that last bullet point is really important. These are manually underwritten. Everyone got used to putting things into a computer, and the computer says yes or no, and then you kind of live and die by that. The nice thing about these products is, we have those flexible income sources and manual underwriting. Going back to one major thing here, the affordability of the loan. these loans will allow 40-year terms. So when you think about customers looking and they need to kind of, again, stretch because these prices are increasing and rates are kind of all over the place, that 40-year term on a non-QM or a special financing loan is going to really reel in the customer. It's about being able to make the payment. And for you, as well as the originator, it's about maybe a second opportunity for that borrower in the future by helping them the first time around.
What's the usual debt to income ratio?
I mean, you'll see on certain, products, whether it's jumbo or whether it's, the agency loans, depending on the customer's profile, 43, 44, 45, you might get 50.
Yeah, conventional, you won't really get above 45.
Yeah.
Very, very rarely will you. And then to get even to a 45, you're looking at 720 credit scores. If you have a 650 credit score, you're not even getting above 41. Right, so it's kind of balanced out, two different things.
Yeah, and that's a big thing. Like the agencies have continued tightening things. They try to do different things to keep borrowers out of position on second homes and investment properties. Some of that's been changed again for the better. But we're always with these products really trying to stay ahead, right? Stay ahead, give more opportunities, more solutions with them. 30-year term as well is available. We offer that with the first 10 years being interest only. So thinking about how a customer needs to qualify, maybe the rate will be a little higher because they're going to use bank statements to qualify versus traditional, 1040s. We bring them back into a position where the payment doesn't hurt them so much. We qualify on the fully advertising, but then we give them that 10-year IO, and most people will refinance or upgrade their home within 7 to 10 years anyhow. So it just makes sense that they're only paying interest only for the time being. And back to affordability, and I think that's just one of the things I want to drive home why non-QM is really important. It's the fact that you don't want to have to worry about extra costs associated with the loans. So none of the loans we're talking about or the features of the products today have any mortgage insurance. So that's another thing a customer gets their head around. They go, wait a minute, I got to pay more, and then there's mortgage insurance, and then there's this, and now they're out of competition for the house they're looking for. Before we go any further, any questions on what we're talking about? Yeah, go ahead. Questions are welcome.
Just kind of remembering the horror show of 2005.
Yeah,
2006, and all
2008.
these creative products.
Mhm.
All right, so you say 30-year term with the first 10 years interest only.
Mhm.
Can you just give an example of what does that look like
Yeah, it's
versus,
Mhm.
you
In terms of the concept around it is this, one big thing is you qualify on the fully amortizing payment. So we're not letting them get away with qualifying on a lesser term. But with that, if you look at an average rate today on these kind of products compared to your traditional agency loan, factoring in interest only, I would say the difference per 100,000 in loan amount would be maybe a difference of less than $25 a month in payment for that mortgage. So they're right in that same zone. So from an originating standpoint or customer comfort level, you want to just understand that they're going to have the payment they want while the rate isn't as important. So it's really about still giving them a straight 30-year qualifier. We're not going to ignore anything, remove anything, because we're using other ways to qualify them. We want to make sure they can qualify on that full term. But then that payment becomes more manageable if they have to take on what you'll see in some of these products, more of a Band-Aid loan, something that just serves what their situation is right now.
So you're saying is they're still qualified for the 30, so at
Mhm.
year 11, they're not going to lose their house because they're not going to be
No,
able to afford the payment.
we're not going into those ways, right?
Say
We're not,
that,
it's not a
10 years
balloon or anything,
Yeah.
right?
And in the first, 8 to 10 years of
Mhm.
the loan, you're paying so much interest normally anyway, where
Right.
your principal is minimal.
Right, exactly the concept behind it. So these are all kind of what make up a non-QM loan that you won't find these things in agency, traditional loans, FHA products. So just to give you some perspective on the product offering. So one of the biggest things, I think the number one loan that someone takes on when they do a non-QM or special financing loan under these types of products is they look at bank statements. Self-employed people are everywhere. I mean, Angela and I have been working together for 3 years. I, kind of came and introduced these products to the sales team, and people would say, I don't have non-QM where I am. I don't have these, no one needs this. There are self-employed borrowers everywhere in the country, and you guys have examples of helping people, using these products already. So we use, instead of your traditional tax documents, right, your 1040s and your schedules and all these things, we use we take out the IRS tax documents, And instead, we use bank statements to qualify the customer. If I'm a self-employed borrower and I have a business account or a personal account that's tied to my business needs, I'm analyzing what's going into that account. And guess what? I'm getting more of a real-time picture into their finances than I ever could from what they told Uncle Sam a year ago, right? So we look for these deposits that go into the account, and then we measure that against, depending on the business, what their expenses are, or if there aren't any expenses, they can get credit for full deposits. And then we add them up and we average them over 12 or 24 months. And this is going to serve anyone from an Uber driver, hairdresser, to a contract employee, possibly at a major corporation. We have solutions for that. Mom and pop shops, car dealers, everywhere you go, self-employed people that are looking to buy homes. So this is a real good way of understanding that this customer doesn't have to worry if he can shop around, if he's going to qualify. He thinks his tax returns are great, but he took all the write-offs, right? And now it looks like he can't finance the shed in the backyard, right? Reality is, when you look at people's bank statements, and you can attest to this, you see money going in, money going in. What they told Uncle Sam is legal, and it's not really what we're looking for. So we calculate that income with our company. We calculate it the same day. If you send in 12 or 24 months of bank statements to our team, we have an entire desk that does an analysis of these bank statements. Additionally, we have artificial intelligence behind the scenes that reads the bank statements. So as I mentioned, we're looking for fraud. You can't do a little cut and paste and put something over here and put Wells Fargo on top of the Bank of America statement. It's not going to work. We've caught that with brokers, around the country. We keep an eye on that. So we get real borrowers really qualified for the real home that they deserve. So same day calculations, even on pre-purchases. So that helps you guys.
Now, when you say same day calculations, what does that mean?
So we send in 12 or 24 months of bank statements. Our team looks at it, they analyze it, and they give back that income. That's a certain income that we will use throughout the rest of the loan for that borrower based on the bank statements.
So Val, down to our level, right? You'd call me up, send me the borrower. I'd analyze, find out, okay, he's a contract, writes everything down. His bottom line, his adjusted gross income on his tax returns is $1,000. Then I bring up, hey, I see that you made on the top line 1.2 million, on the bottom line 1,000. Then I'll bring up, hey, can you send me your last 24 months bank statements? When I get those, I'm not going to analyze. I'm just going to look and see. If I see a lot of deposits, then that's when I send them to them. And that's where they do the same day calculation. So by the time I get the bank statements, I send them to them. I'll say, hey, Val, I just sent it to the first guarantee. Within 24 hours, you'll know if this person can get a mortgage or not.
And so I guess I'm just wanting to get an idea of like, what are you looking for? Like, the average
Right.
monthly balance or something like
So
that.
we're gonna-
You see what I'm saying?
So I'll walk you through it. I was going to keep a high level, but I was like, I don't know. Nobody's going to technically want to know, right? How the sausage is made. But okay, I'll
want to know.
I'm cranking up the sausage maker here. So there's two ways we look at it. If I have a personal bank statement, I'm giving them credit for 100% of the money that's going into their account, as long as they don't have any business expenses. Think like an Uber driver, right? There's no expenses he really has to drive Uber. So 100% of the deposits that go in, add them all up, and then divide it by either 12 or 24 months of bank statement, whatever I'm using. That's it. And that income is the same income when we do it up front that follows that loan all the way through to underwriting. We might occasionally need one more updated recent statement to continue to average, within 30 days of closing, we want to see the most recent statement. But we're taking a look at the 12 or 24 months, calculating it. We're running it through our AI technology. Based on our formulas, we're looking for large deposits. If there are large deposits, we'll ask where they came from. We treat every borrower like its own story, right? So if you tell us more about what's going on, this is going on, deposits, seasonal adjustments, right? You might have a landscaper where everything's going great for 6 months and then it slows down. We can work with that. Just has to make sense.
So what about, so the Uber driver doesn't have any business expenses,
Right.
but obviously they've got living expenses. Are you looking at that and taking that into consideration at all?
I'm just looking to see how much money he makes, just like you or me, right? If I'm still gonna run a DTI on that income once I figure it out, all of that, the income calculation based on his expenses, but as long as I don't see anything that's going through those bank accounts that are for, expenses for his business, whatever it is, we're good. Think dog walker, piano teacher, there's nothing really they have for expenses. Now, if I have a business account, right? I'm a more dynamic business. I need a business account to keep things, over here. Then we go by a formula where we give them credit for 50% of the revenue deposits that go into the account. So I get 50% is mine. We do 50 as a baseline that we assume the other half is expenses to run the business monthly, if we're mentioning expenses. But we don't go through line item and figure out what the expense factor is. We just say, let's start to give by giving them 50%. And then if that's not enough, they can give us a CPA letter from that self-employed borrower's accountant or whoever prepares their taxes to state what the true expense factor is. So if I'm an IT consultant and I work from home, my expense factor might be 20%. So I get credit for 80% of those revenue deposits as long as the letter states that. It just has to make sense. Don't tell me a restaurant has a 10% expense factor. I'm gonna buy that.
So we're still gonna, once they calculate the income, we're taking the expenses from the credit report.
Mhm.
So you're still taking those. Like the only thing that would show up on a bank statement that would be a deduction or an added expense is, let's say a borrower doesn't tell us they have a mortgage, right? And the credit report doesn't show a mortgage, but every month Bank of America is taking out $2,500. That's now going to get added in the DTI if they're not selling that house or what have you. Following? So that's the only things that could possibly come off the income of the bank statement.
Good point.
But once they calculate it, this is what I really want to hit home. Once they calculate it, they're done. So like when we come back and go, yes, they're approved for this loan, let's go get them a house. Well, let's jump on it. Let's jump on it as quick as possible so that, because they've already calculated it. And that's pretty much the underwriting, unless once again, you run fraud guard and a BK shows up or a foreclosure shows up. Something shows up that isn't anywhere in the initial package.
Exactly.
Right. And that's why I'm now comfortable bringing it out to my realtors, because they added this little caveat, which is nice. Like you don't have to have a house to find out how to do this. Right. We can do this all before anybody finds a house. And then the other thing I just want to bring up is it goes to 3 million. Now, start churning your mind. You don't get $1 million listings here very often, but when you get an opportunity to go in for a listing of a property that high, you bring up, hey, by the way, my lender is going to open up your pool of buyers, because now that self-employed buyer who makes a lot of money, we can do the loan. It could be a little bit added push to you getting that listing when you bring up, hey, we have additional products up that are going to cover your loan. Anybody wanting to buy your house, it could be a little bit extra. So I'm always trying to figure out a way to get a listing.
And that's true. And then these things all, tie into the fact that, remember, this is a self-employed borrower who only needs to be self-employed a minimum of 2 years, right? Someone who's got a 2 year, and they could do it 12-month average. They could go by just the most recent 12 months of bank statements. And what we can do is we work back and forth to figure out what's the best option and solution. So we have that income figured out. We have consistency, because then that income gets punted to the underwriter, and they again might add an extra month if they have to. But other than that, we have income figured out. We call these loans non-QM, but ultimately, if that's the one thing that makes it non-QM or special financing, then the rest of the loan that they have to deal with is exactly what we're already dealing with. Still the same credit report, still looking at liabilities monthly, still getting 2 months of bank statements to close for the assets to close, and then an appraisal. All right, so it's a real boring loan after you do the income.
What are the credit requirements?
So credit can go as low as 620 on one of our programs. We have another program. We'll talk about some credit challenge customers. We can get down to 560. Now, you hear a credit score like that and you go, here we go, subprime. 560 is a customer that we're going to make sure they have 35% down to buy their house if they have that credit score. And you're going to need to have trade lines on all these products. We need 3 trade lines with a 12-month history or 2 trade lines with 24 months history. We look at housing history. We're careful. Some say too careful, but we want to be around doing this for a while, right? So, and we don't want to be on the front page of the Wall Street Journal or Fortune or CNBC every night, right? So we do this very carefully. That's one thing I want to point out. Good questions on that front. Credit's always analyzed and examined. They can get the credit vetted up front too. So if you want to know if a credit guy's kind of on the fringe credit-wise, but he's got money in the bank and maybe he had a life event, that's part of what we try to do with these products. So back to bank statements real quick here. 90 LTV, that's where no MI is required. Again, 90 LTV, 10% down for using bank statements to qualify, all the way up to 3 million. We focus on the large loan sizes, which is good, but start at $50,000. you know, someone's just looking for a little bit of a small home or a second home or something, they don't have to go for the big loan, or they don't have to they can put more money down and get the deal they're looking for. Owner occupied second homes and investment properties. I have some other things on investment properties in a little bit that are pretty cool too, unrelated. And then these serve 1 to 4 unit properties and condos. And we have some offerings for non-warrantable condos. I didn't want to kind of take you guys down that rabbit hole, but you know, condos are always tricky, you know, so we got solutions for those condos as well. So before I go any further, questions? Anything?
This is definitely the most popular loan that we see,
Mhm.
you know, that it opens up so many doors to so many different people. I mean, it's just,
So when someone puts in an application,
Mhm.
how long does it take to get the final approval clear to close?
if you, let me answer that.
I'm gonna let you answer that.
Since this is kind of like how we handle renovation loans, Evesham Mortgage, we ask you to give us a little bit more time because there's a third party involved. The thing to understand is all they're doing is underwriting the loan. They're underwriting it, we're still doing the package, we're still sending our money to the table. So once we get the clear to close, we're back in charge. So I would say, you know, give me at least 45 days. You don't need to give me 60 or 90, because remember, we've already pre-flooded most of it over there anyway. You know, and I always tell everybody, you do the on, so let's say it's a vacant house. You do on or before, give me 45 days, but then you tell me, well, we'd really like to try to close it here, but everybody understands we might not be able to close it till here, and then we can work that way. If it's not a vacant house, then just give me 45 days, and that's, if I get it clear earlier, I'll call you up like, hey, it's clear. So whenever you guys want to close, you just gotta give me 3 days so we can do the CD and all that other stuff.
Yeah.
So what about the pre-approval process? You know, is that pretty much the same because you're getting all this person's information and you're sending it to these guys first? Right?
24 hours. Once I get everything from that borrower, 24 hours. So it all depends on how, you have that really great borrower that's getting me the stuff as soon as I talk to him, it's gonna be within 24 hours.
Yeah.
You get the borrower who sends me 6-month statements here, and then 2-month statements the next day, and then 2 more the next day. Only sends me 1 page instead of the entire bank statement.
Or something on their phone with no.
Yeah, taking screenshots of 100 pages of bank statements.
We've seen it all. We've seen it all.
One at a time.
So good.
Yeah, the biggest thing, especially with you guys, you know, you guys are good agents, and just, you'll talk to your borrower and say, hey, listen, even if you got to, if you're bringing 24-month bank statements, especially get in a car and drive over to Evesham Mortgage and drop them off, or just come here and drop them off and Evesham Mortgage will run down and get them, you know, but we just got to control the borrowers.
Yeah. Did you see the new portal we rolled out?
No.
On our webpage, I'll show it to you at the end. Now allows you to put an upload.
We just don't upload.
Yeah, we're working on rolling out.
And we got the ability too. I mean, when the borrower comes to the
Yeah.
pre-approval
Yeah.
for our portal, when they fill out the application, all they gotta do is hit upload and they can upload all their statements in us. And then realistically, that can be done. They do that within 5 minutes. I send it over to them, and now we're maybe a couple hours.
We're probably maybe within the next quarter going to be give you guys the ability to run the bank statements yourself.
Oh, cool.
Yeah, work on that. So, you know, this is an emerging market. You see some things that are definitely new or you know, unfamiliar. But as I mentioned, we put a lot into ensuring the performance on these loans will be strong, and you know, risk aversion is a big part of our value prop. You know, we're part of a very large company that really is invested in these products. So let's talk about the 1099 only customer. Forget your bank statement customer. Maybe you guys are 1099. I'm not sure, but you know, a customer who only is paid by 1099 as this new gig economy begins to explode or has exploded in the last few years. We have a product that lets us just qualify off of the 1099 only. Okay, so we get the 1099, you know, gig economy workers. We take a 1 to 2 year average and give them up to 80% of what's on that 1099. Okay, we can take that to 90 LTV.
That's great for realtors.
I mean, you guys are probably like, right? I mean, it's a great offering. We're happy to finally roll that out. Still, the loan amount is 50,000 to 3 million, so wide area there. Owner occupied second homes and investment properties all in scope, and 1 to 4 unit in condos. The 1099 is probably one of the most desired products after the bank statements for customers who are, you know, think about someone who's a contract employee for a major corporation, right? It's really tough for them to get a loan right now. when they have just that 1099, and everybody wants to comb through all their other tax returns and everything. We don't look for that. So we do run a few other checks with documentation, but this is really all based on what your 1099 is telling as far as the income we give you.
Paul, still no MI?
No, am I? No. Yeah, my guys, still my friends, still my friends. I was just texting Ryan Fauner.
It's not gonna like it very much.
Last night, he was giving me a lead on some stuff.
So if you're saying 1 to 2 year average, you can average the 1099, how long does that person have to be the 1099
2
employee?
years.
Still 2 years.
2
okay.
years, yeah, we follow that kind of standard run of the mill approach, especially right now coming out of the last couple of years. We just want to make sure people are stable.
More
So-
typical, like a typical conventional, like a 3 year 1099, right? So,
Well, we normal conventional, we're not even using the 1099,
1099,
we're using the tax return.
so, yeah.
After all write-offs and all the other stuff.
Then they don't have enough money.
Yeah, so
Gotcha.
it's-
So we just say, hey,
Makes a
we
big
need
difference.
80%, let's keep moving, right? That's how we like to do it.
Nice.
Any questions on the 1099? All right. This is still one of my favorites and a little outside the box, but it makes sense when you think about it. I'm sure you guys have all run into buyers who are out there and they're, they have a lot of money sitting in the bank, but maybe they just don't have a lot of income or any income. They're like, how can I not buy a house today? Like, I can buy this house cash right now, you know what I mean? And some people have been doing that, but we have designed 2 options for customers who want to take those assets that they have sitting in the bank after closing and use it as income today to qualify for the loan. And so we have assets as income. We also call it asset utilization. And we allow it with liquid and non-liquid accounts. So you could have your checking, savings, money market accounts, CDs, stocks, bonds, mutual funds, and even retirement assets, regardless of the age of the borrower, can be used as an asset treated as income. The biggest thing I'm going to show you here is point number 2. There's no liquidation of the asset ever required other than their down payment closing costs. So if someone's sitting on $2 million in the bank after closing, they don't even need another income source. Right? They could get a little pension, Social Security or something coming in, but we look at what they have left over. We don't set up any special draw schedule, no pledging of the asset, no mother may I from their financial planner, right? It's all based on what's going to be left over after closing, and then we assign a formula to it. Keeping it high level, I didn't want to go into all the details, but if there's questions, I can tell you real simple. Net assets that are available after closing, we divide it by 120, and that becomes income. That's it. Now, if someone goes standalone and there's no other income, then we do put some additional guardrails around that. We want to make sure they have a certain debt to income. I think we max it at 45 when they have a standalone.
That's correct.
I think that's fair. I mean, you got to draw the line somewhere, right? So again, we can do this at 85 to 90 LTV, depending on how they're qualifying. No MI. FICO down to 680. Okay, so 680, that's below the national average right now. Loan amount still 50,000 to 3 million. Owner occupied second homes and even investment properties can allow and leverage this as a way to qualify. So I think there's a lot of, your standard property types as well. There are a lot of borrowers, especially over the last couple of years, you would say that have made a lot of money, right? Done well with the market. People have inheritance, settlements from lawsuits,
Sold businesses.
Retirees.
That's right. Retirees who might have worked for the government, and they've been in the government for 35 years and they have, $500,000 to $800,000 in
Mhm.
retirement and pension stuff is all sitting there.
Yeah.
There's a big world once you
Kind
now
of
that you hear about the loan, all of a sudden you're gonna go, wait, I had that borrowed it, went on Social Security, retired early,
Mhm.
but had $1 million in the bank, didn't want to go working.
And for like originators, I've been talking to a lot of them again, with things opening back up. And I'm like, this is your deal saver. This is a deal saver where you never take a look or think about the money that they might have afterwards. And it can bring that ratio down just a little bit if they already have other income. If they're pushing the envelope because house prices are up there, everything's a little shaky sometimes, I go, wait a minute, before you even start crying about your ability to qualify, how much money do they have left over? Oh, they have a retirement account with $300,000. Well, 300,000 divided by 120. I'm not good at math. I work in finance, I'm not good at math. Whatever that is, that's more income than they had a minute ago, right? In that time that it took us to figure that out, right? So that's something just to keep in mind. These guys have the power to make deals work that maybe people are kicked down the street a few other places, they can't get it done.
So let me explain to you why the no liquidation required is really, really important, right? So conventionally, you could do the same thing. So, and this comes across a lot. That's why I know there's a big market for this. So let's say somebody has $500,000 in stock, but they're on Social Security. Well, we can tell them, you need another $5,000 a month in income to qualify. They actually then have to go and pull the $5,000 every month out. And we have to document that for 90 days before we can get the mortgage. So this is the same product, but they actually don't have to take the money out of retirement, because you could do it conventionally, but you have to take the money out of retirement. And then if you're using it as stocks, and if you're using your retirement, you have to be of retirement age. So conventionally, there's a lot of different things here. You have the money, they're gonna do very similar calculations. So it's a much easier loan to get. And then you don't have to try to talk that person into, somebody who's 65 years old doesn't want to pull $5,000 a month out because they're going to live till they're 100. They don't want to be doing it just to get a mortgage, right? So
when it comes time after, this person buys the house, pays the phone or whatever,
Yeah.
it is time to repay the loan, then what happens?
They pay a mortgage payment every month.
there's not still a mortgage.
I mean, that's the time when they start pulling that money out.
Yeah, and that's up to them.
But
But now that's up to them,
Yeah.
right? That's not us saying you have to take $5,000 out, because we need you to qualify.
Or at their discretion, if you're talking about like a retiree who's got the money in the bank, they may be drawing from it as they need to, but they also have that pension, that Social Security, and they're managing their money this way, right? That's why we look at the credit
Right.
score. And they go, okay, I'm gonna take a large distribution to cover my payments of all expenses for 6 months. I'm gonna take this big chunk out. Like, we work off the idea that these people are financially savvy, they understand how they're doing. If they got the money, that much money somehow, then we hope that they know how to hold on to it.
Val, a couple of my borrowers
Yeah.
have taken like the first 12 months out, put it in a bank and just do the ACH debit. And then now they don't even worry about the mortgage anymore. And so the things like that.
But it's funny because we're here with you guys as realtors, but we recognize with these products and, really start thinking about them. If you guys want to recap of this anytime, let us know. There's so many new referral areas you can find these borrowers, right? Financial planners, wealth advisors. They love this because unlike the agencies, the money doesn't have to leave the account.
Yeah,
They're not seeing their money drawn out. They're keeping it there.
it opens up another resource for you guys. We're always trying to open our sphere. Well, this opens your sphere to financial planners. Hey, I got a loan for you where the money's going to stay in you refer the buyer to me, the money's going to stay in your account and we can get them the mortgage. That's an option. Financial planners love to hear that concept.
Yeah.
No financial planner doesn't want to lose $150,000 because someone wants to buy a $500,000 house,
Right.
where we have the ability to do that now.
And we could probably talk about it with this, project we're kind of putting ourselves through today, is how maybe to leverage some of the white label marketing that we already have designed to reach those. 'Cause we have white label marketing for the originators to use, so they can reach financial planners, wealth managers, CPAs and tax preparers.
And when he says white label, that we can put your information on there and you can utilize that.
Yeah. We always keep the content up to date. You can do your worst.
Can we go over to the investment right now?
Yeah. I'm gonna jump ahead. Make sure.
This is Jim's favorite product.
I wrote these slides last night when I had a glass of wine. I just want to make sure.
Okay, all right.
I'm a PowerPoint guru, but not after a couple of glasses of wine. You never know what you're going to get on the slide. All right, so I love this product too. I love the concept around how this can help you work with real estate investors. And I live right across the bridge in Philly, and I'm involved in the real estate investing groups here in South Jersey and in Philadelphia. We have designed a product. This is one product itself. Some of those other things were features within products. This is a product unto itself called, I'll say for everyone here, and I hate the terminology everyone else uses, but we just say this is a cash flow for investment properties. Cash flow for investment properties means, does anyone here own an investment property? So so you own investment properties already. Do you have tenants? Do you like them?
Yeah.
I'm just kidding.
Right.
Let's see how
Right now, I do, they're paying.
Exactly. And then you probably like them because if you do have a lien against the property, a mortgage, or even you pay taxes every month, you want that tenant who you like very much to pay your mortgage for you, essentially, right? Unless you're a nice guy and you're like, you want to keep it maybe the other way, but we can work with that too. So the whole idea of this product is we qualify that borrower for the purchase of an investment property, 1 to 4 units or condo, on what that cash flow is, and that's it. So in other words, I bring in $2,000 a month from my tenants. Does it cover my mortgage every month? Right? If it does, or better, then that's all you do to qualify. Cash flow, debt service coverage. That's the Wall Street term. We'll throw that out. DSCR. But all that means is, again, think about it as yourself as an investor, or, owning property. Does someone pay rent monthly to me that covers my expenses on the property? If yes, then you qualify for the home. And we allow this on vacant properties. So someone's going out there and looking and they're like, I want to buy this investment property. The only thing we need to see is that 1007 or 216 for the appraisal to determine exactly what that rent would be.
Those fancy numbers you just said are what we call rentals. So the appraisal,
Thank
the appraisal will go out, comp out the house as normal, and then there's an additional form where you compounds the local rents. So if you guys have a buyer and we're doing this product, make sure that the rents are going to comp out if it's vacant, so don't, if you think rents are going to be 1,500 and the mortgage is going to be 2,000, that's not worth the problem.
Okay, you got to break
You got
even.
to do a little work first, make sure the rent's covered. And then you gotta-
So what if the house is a little jacked up? And you've got to make some repairs.
So all that's a great question. All these under our product, all the properties have to be habitable and livable condition. If there's any repairs called for on the appraisal, they have to be completed prior to close. So it's not a rehab loan; it's more of a buy and hold.
Okay, and you do have to do 20% down.
Yeah, so 20% down. When remember this big caveat up here, I'm not looking at your personal income. I don't care what your W-2 says. I don't care what your pay stub is. It doesn't even show up in the file once. All right. I don't care about your other rental properties, whether you're winning and losing on them. Okay. It's all just based on the subject property breaking even. And we don't take a vacancy factor off the gross rent. That might be something you guys don't ever think about.
Okay.
But Fannie, Freddie take 25% off to get a nice little 25% haircut. If the rent comes back when we're looking at this and it says $2,000, you get $2,000. Okay, you don't get $1,500. You get your full rent. Okay, so it's just an amazing program. 20% down. I think a lot of investors are perfectly okay with that. That 640 credit score will go down to. That's only 25% down. A 640 credit score buying an investment property, that goes up to $1 million loan amount, by the way, at that 640/75 LTV.
Is this just residential or commercial also?
Residential up to 4 units.
So
And
conventionally,
that's inaccurate.
conventionally,
No glass of wine.
you wouldn't get below a 680 approved on an investment property. Even 20% down, maybe 25 or 30, but the rates conventionally will probably be as high as this rate because of the FICO score hit in an investment property. So, it's actually a better product than a lot of conventional stuff with credit scores in that range. When was the last time an investor had a 660 credit score that you would say you can buy an investment property? That's not anything that happens anytime soon.
Yeah.
Once again, opening up another pool of home buyers and investors to you guys by having this product, in our pocket.
Yeah, I didn't even put it on the slide here, but if you guys are taking notes, I'm not sure if you guys are already familiar with it, and I can introduce you guys even to some of the groups I work with. But if you go to the website, it's nationalreia.org. REIA.org, National REA. That is a group where you can find where the investors are meeting virtually or in person around here. Over in Philadelphia, Nick Tang does a lot of work with probably twice a month. They're meeting and they have happy hours and gatherings. It's great. You rub elbows with these guys and you meet the investor and they go, you tell them, I don't need your income. Their eyes pop out. Oh, and by the way, I didn't mention on this slide, you can get a gift with this product. I don't know the last time you saw an investment property, we can get a gift, but a borrower
Oh,
can get a
yeah,
gift.
no way.
No, it's like never heard of. As long as they have 5% of their own funds and they have the reserve requirement, which is 3 to 6 months, they're in the door.
Think about the investors, who have multiple properties, right? Fannie Mae has a limit on how many properties you can get. breaking down the tax returns, and now you're asking that investor for all their leases, all their tax, everything.
Schedule E.
We just want rent rolls.
I never want to see. Schedule E.
It's, when you say that to the investor, you're done throwing all your tax returns out. You're done, answering all these questions about how come this property is
Yeah.
vacant? How come you spent 15,000 in repairs on this property, but you didn't get any more rents? Like all the stupid things that I gotta ask. You don't have to ask
They've
anymore.
thrown that out.
And it's really a great product.
It
This is a personal guarantee, right?
Yeah.
You
So
can't
that's
do
what I
this
did.
in LLC.
You can close it and hold it in an LLC, but each bar rep does have to sign a personal guarantee.
But we can close an
But
LLC.
they can hold it in an LLC, which a lot of investors might do. I left that off.
That's awesome.
It was really good line.
National
nationalreia.org. And you can sign up, they put out a newsletter every Friday. And, email, and it focuses on what's important to investors.
So you said, I'm sorry.
I don't know, so it's just something that if you just go through it real quick, scroll through it, there's articles, there's links to things. Just getting into the headset of the mindset of the investor versus the traditional, owner occupied second home buyer and a borrower.
Well, I'm just trying to think, this has been out for a couple of years, right? So it's not new.
Oh, yeah.
Yeah, the debt service coverage been out for a while.
Yeah. So who are you seeing that's using it the most? I mean, it's
That's a great question. That's a great question. I personally have seen all manner of people, and I find it very interesting because our access to information and, this day and age, people know their kind of financial profile a little bit better. And now people are learning about these things more. So I've seen at the real estate investor meetings, anything from like generational buyers, like you have a mother, granddaughter, buying a property together, their second or third property together. I've seen 20-some-year-old kids that are like, I'm never gonna work for anyone a day in my life. I'm gonna figure out how to have a bunch of investment properties. And then I know you guys are in more of the purchase side of the world, but then you see people coming and going, I'm gonna take money out of my other two I own, put it into the one over here I'm gonna buy now. And, and then you see people that form little personal collectives, hey, let's go in together, because you can go in together if you both have the credit. You don't have to be spousal or anything like that. So you see all manner of people from kids through, serial investors, all the way up to first-time investors. And again, I've met more people that have families trying to build wealth, say, there's only so much dirt, right? Let's buy some dirt and make some money.
Jim, what I've seen recently in the last, because of the success of the real estate end of it, I've done 4 loans with realtors that said, my one realtor has only been in business for a year, but they're doing really, really well. Well, she teamed up with her brother, they created an LLC, and they're gonna do this product because she only has 1 year of 1099, so we can't use any of her income. And, but they have the money because they came together. So they're out looking right now, for something. So, and I've seen that.
And,
I'm sorry.
and I was just gonna say one other thing, we can add to this is the fact that while we never let people qualify on interest only, that interest only option I mentioned earlier on is also available in this. So thinking about the fact that I'm gonna pay interest only, which means smaller payment, but collect maximum rent, which rents are up about 7, 8, 9% right now. I'm putting more money in my pocket and I'm just gonna either turn that loan later or I'm gonna do something else with it. But for the time being, I'm gonna maximize my profitability beyond break even. I mean, most people, if you can't figure out how to break even, then maybe you shouldn't be in finance.
So following what Paul's saying is, we're gonna qualify on the full amortized payment, not the interest only, but they have the option to pay interest only once they qualify for it.
Now, let me ask, I'm sorry.
Yeah, just real quick.
Oh, yeah.
With a 4-unit, can they have it one unit?
No. Good question. They have to have it completely on.
Even if the 3 units themselves recover the expenses?
It's investment only.
It's, yeah. I'm sure those things happen. I'm sure those things happen, trust me. I'm sure it happens on 1-unit properties. I mean, it's really, tricky to, call BS on someone when they meet the program criteria, but we're pretty careful about that. It's a question.
So in the case of somebody just buying a residential property for themselves, with the interest only, what is a scenario where that would be to someone's benefit? Because I mean, I see what you're saying as
Yeah.
far as like, if it's a rental property, you
Sure.
got income coming in.
Right.
And you're saying, oh yeah, I want to minimize my payment,
Yeah.
and you kind of don't care.
I'll take you through something that kind of would speak probably well to the person that might need your interest only option or solution for them. So we have this opportunity for credit challenge buyers. We have one product designed just for them, and these are not the credit criminals. Okay, we're not supporting them. We're supporting someone who, life event, something happened, hiccup in the road, and
COVID.
I mean, we don't say that word in our guidelines. We had this product pre-COVID, and it was actually #1 product pre-COVID with our Achiever product, which is for credit challenge buyers. So if I put someone in this situation, right, where they can show up with the money down that we require at a 560, which is 35% down plus reserves. And they've had a recent bankruptcy foreclosure short sale, which we can go as little as 1 day out of a Chapter 13 bankruptcy, 12 months after a foreclosure, things like that. We're helping customers who also still have trade lines. 3 trade lines with a 12-month history, 2 trade lines with 24-month history. I mean, we're getting into credit depth still with that customer. And then I factor in, he wants to go bank statements, which you could do. That rate might go a little higher than what they thought they were going to take. So if we can get them to understand that you're getting a lot for your money, right? And a lot of people wouldn't touch you right now. And with that comes a rate, which is with a risk. But, Mr. Customer, we don't want to see you, losing sleep every night, and eating ramen noodles for dinner, unless you like ramen, because it's become popular again. But we want to help you maximize your household budget. Take the interest only payment. Your credit score is 600 right now. We hope and we trust that it'll get back into a better place, and then maybe you want to do something in the future, move up to a different home or refinance, which again is not your bread and butter. But so that's why we take the IO, right? Within some of these features within the products, because we really only have 3 true non-QM products we're talking about. I'm pulling out the features to give you guys kind of a highlight of what we're doing here. Within that, you could layer on things. You could go bank statements and then say, well, I want to use asset utilization with it. You're allowed to do that.
Combine the
You
income.
combine, that's going to add some price, some heavy price to it, right? Because you're doing a lot of, now you're getting into this squirrely stuff, right? So that's another situation where qualified prime borrower, when you combine all the price adjustments, might be in a higher rate strata than what they would be traditionally. So they can take the IO and feel comfortable with it.
So Val, most IO borrowers have an event happening, right? And this is what I see. So like, let's say you have that IO borrower that knows in 6 months, they're getting a promotion. Interest only, IO,
Oh,
right? Knows 6 months from now, I'm getting a promotion, I'm gonna make an extra 10 grand. So I'm gonna keep interest only until I get that promotion. School teachers that know the next year they're going up 5%, they might take the interest only. There's some business people would rather pay the interest only and then kick extra principal at their own will to buy the loan down quicker. That way, so I had one person when interest onlys were available, like they're back again, they were not available for a long time. They got a huge refund on their tax return every single year. So that person wanted to be an interest only, and then that refund went right to his mortgage every year. So it's a manipulation of the mortgage that person's going to say. Back in the day, people were getting interest only because they couldn't afford anything else. Since we're not qualifying them on the interest only, it's going to be somebody who wants to use it for their benefit.
Seasonal business, things like that too, we said, right?
Yep.
Yeah.
Seasonality.
And it kind of goes back to the theory, and what I like about non-QM is that you're just helping borrowers who are, not always working in the traditional sense of, and our economy is not traditional right now, right? And so I don't know if there's any such thing anymore, but we're just helping that borrower who's, really deserves that home, and we're analyzing them in a way that others won't consider. And it starts to become really common sense, makes sense deals that we're putting together. I mean, month over month, our production, once the refinances slid down and people stopped, has been tremendous. And it's been a lot of people that come out and looked at the process and said, oh my God, I have these borrowers, I have deals I'm turning down right now, that fit some of these circumstances. And the good news is, the last thing I'll say is, I think we can, agree, we can look at all this stuff up front and know what we're working with. It doesn't have to go through an arduous process as the loans get underwritten. We can kind of start to figure things out with our structure desk we have. They take in, I don't know how many items a day, probably 50, 60 different things they're looking at every
I'm gonna
day.
call them all Rick's guys.
Yeah, yeah. So, yeah, so anyhow, it's, good questions, what other insights can we add on this?
Jim brought up something when I talked to him about this product is, if you guys, anybody wants to reach out to investors and try to hold a class, right? Whether you hold a class here, or we hold a class there, or whether we go to a restaurant and hold a class and tell them we're gonna buy the investors dinner or lunch. We can go to Indian Springs down in Marcos and, sit outside and, and have investors. And I'll come down and, Paul will come down and we'll go over this specific investor programs. If you want to do a home buyer program and advertise it, have you had a foreclosure or bankruptcy in the last 12 months? You can still get a mortgage. Call me, right? Nobody else is doing that. Like, nobody is doing that. No realtor is truly utilizing the non-QM space because they don't know about it yet, right? Because not many people do it. Not many mortgage companies do it, right? It took me a while to do it. It took me a while. It took me a while for these guys to talk me into it. So I let all my other LOs be the guinea pigs, and we're closing a lot. It's opening a lot of doors for a lot of people. We want to provide you with every source you have, And I would look back over the last 3 months of buyers that maybe somebody told you they didn't qualify, just to see. I mean,
They
just
say go 6 months and.
call me back in
see me
6 months.
Yeah.
They definitely didn't have this, so they didn't look through it. You know what I mean? And we have a really good personal relationship. So when I pick up the phone and call Paul or Angelo, it's right away. We're not going to be dragging things out.
What would be acceptable trade lines?
In terms of what we'll allow.
Anything shows up on your credit,
Yeah, just some credit. We don't have alternative trade lines yet. We're kind of working on
credit
it.
cards, student loans,
Yeah.
anything that will show up physically in the credit. It's not going to include rent, car insurance, cell phones.
Yeah.
But now sometimes these younger people, it's hurting us in the conventional world, but they're adding their PSE&G bill to the credit report.
Yeah.
They're adding their cell phone bill to the credit report. It kills us because now that's a debt we have to use in qualifying, but for them, it's a trade line.
Right.
They're using that Experian Boost.
Yeah,
Oh, because is that what that does? It just like puts your.
it
stuff
adds some other
It goes through your bank accounts. It
Yep.
sees what type of
PSE&G.
common
South Jersey
bills you
gas.
have. And says, oh, you pay that, you pay that.
So it gives you
So it
good
adds their
for making
credit
those
score, but it
payments.
shows more debt.
It,
So-
it, it hurts us because
Right.
it's showing more debt.
Good, yeah.
Right,
You know what I mean?
yeah.
Like I've had a couple that I couldn't do.
But if
it
they didn't
because-
have credit, you couldn't have done them either, so.
It's kind of a chicken, it's a paradox.
Yeah.
What's better?
So, yeah, what other questions can we, let me ask you this, honestly, did you find this enlightening, interesting?
Very much.
Things that you hadn't thought of or seen before?
Excellent.
Tell your friends. And,
Well, we are, and that's why
yeah.
We're recording.
and I spoke, I mean, we're
Used to being recorded.
recording.
I guess I'm supposed to tell you that.
You're scratching off all the information you had on there, it was recorded.
Yeah, you missed it. He was doing it in a glass of wine last night.
Two left.
So what would be, thinking outside the box and maybe with you guys, just because you're coming from a different perspective.
Yeah.
What would be, as we talked about, first time investors, first time home buyers?
Mhm.
Who's another category? I think, like I said, the agents, every time I interview them, they all want to start investing in properties. So I mentioned at this meeting, I thought there'd be more people here today. But again, it'll get out there.
Yeah.
Who else could you, like, I mean, I'm thinking contractors, I'm thinking.
Oh. Builders, contractors.
Anybody in
Self-employed.
in the
Anybody, small business association, chamber of commerce, wealth managers, asset managers, divorce attorneys, bankruptcy attorneys. Because we're, serving these customers here. Credit challenge,
So all the documentation, bankruptcy, and all that kind of
doctors,
stuff.
we don't have a doctor program.
We've
we
got
got
$4
like-
million.
Yeah, real estate collector tax burden.
Yeah.
Why?
It's a pretty wide net. I like the idea of getting a group of real estate investors into a room. I'd be happy to, I kind of miss that, like where I came from before. I was at those events all the time in Upper Bridge and South Jersey, talking to the investors. It's fun. I mean, they really, this has certain things that they know are, if they're seasoned investors, they know what their hurdles are, and when they hear that they don't have them, if you take one hurdle out, they're gonna stick to you.
I have a
Do
couple
you
of
think as
questions.
agents, I think would be interesting, would be a couple of, like, examples you should do with the mortgage, you know, put this much down and all that.
Right.
For investors, you sit there and go, rents this, plus 20%.
Mhm.
You know, so whatever it is, something that would be kind of a thought process.
Very
Yeah,
linear,
yeah.
yeah, very, yeah, straightforward.
And we would, couch this a little bit differently with that audience, I'd probably get into more of the formulas and calculations and the grid, so they could kind of see how much more is in this. So I kind of kept it high level, for this cash flow.
I would bring an actual deal. Like we have the investors there, I'd bring an actual LLC deal, show them exactly how it works, show
Yeah.
them what the rate was, show them what the payment was,
That's great,
show
yeah.
them. That way they actually see, hey, this does work.
Sorry, I have to go.
Okay. No.
But I'm be very interested in bringing a couple investors. and something else.
Just reach out to me and we can
Yeah,
organize
for
it.
sure.
Right.
All right, thank you so
Yeah,
much.
Appreciate it. Yeah.
Thank
no
you.
problem. Nice to meet you. Yeah. What other questions? I can see the look on your faces. There's questions.
Val's searching her sphere right now.
She's
Well-
setting up deals.
Well, what states are we good for?
We're,
Every state but Hawaii.
Well, Jersey, PA, Florida.
where you're living.
Oh, for you, yeah.
Yeah, Jersey, PA, Florida. Soon to be 7 more.
Nice.
Okay, but I'm just saying, so,
But right here, Jersey, PA, we'll go.
You got the Jersey Shore, you got Poconos, you got those areas that are like resort based, where people buy investment properties too. Oh, yeah, if I didn't have to worry about how much income qualifying I
so
would need, I'd be nice.
that's
If I
fair.
had enough money to put down in a shore house.
Resort houses, does it do it with the weekly rentals or not?
No, not from a qualifying standpoint. If they do Airbnb or VRBO, Robo, however you say it, they can do that, that's fine. But we would still qualify, if that's the case, off of the market rent from the appraisal.
Gotcha.
Yeah, they could do that.
So they could do it, but
So if they're
we're
getting
qualified.
$2,000 a week, but the person, if the monthly people are getting 3,000, you're only going to do
It's gonna be off the
3,000.
market rent.
Yeah.
Appraisal.
Which still good for.
Correct.
So, I mean, in terms of the formulation, again, I kept it high level. I focused on it being break even, but you can actually go 25% below break even on that cash flow product. You can actually be under by 25% and still qualify. We just lowered it.
Which we haven't seen.
Yeah,
I mean,
yeah, you
it's-
won't. Yeah. The average, we look at the pools, these loans are sold out there, Wall Street firms, Goldman Sachs, all these guys are buying these mortgage-backed securities. The average FICO on a pool of these loans with all these features, all these things we talked about, is in the mid 700 neighborhood. The DSCR is always like 1.2. I can pull every single pool that's been sold in the last year. And when they look at the DSCR average, the cash flow average, where one is breaking even, they're 1.2 or better in the pool. And that's a mix of hundreds of millions of loans. You know what I mean? And then the DTIs are creeping up. I'm starting to see a creep